Welcome to Volatility Trading Strategies and another Q&A episode. So as always, if you have any questions of your own, there's my email address right there. You can ask me anything that's on your mind. So I've got one today that's quite common. I hear some variation of this question fairly regularly, and for some reason, recently it's been coming up quite a bit. And usually when I see a dramatic increase in a specific question, it usually means that there's been some articles or commentary recently that have caught people's attention. So here's a few of the questions. Do you ever sell put options on volatility products so that you can buy them at a discount later on? Another question was, if I buy SVXY instead of XIV, can I sell covered calls on my position to make extra profit? And lastly, instead of being in cash, why not sell put options to make some money while we wait for a trade? And that's just a few of them, but all great questions, and they're essentially asking the same thing. So even if you don't trade options, I still want you to watch the video through to the end, because I'm going to be talking about a lot of concepts that are relevant not only to investing in volatility products, but just investing in general. And just to clarify one thing before we get started, my main volatility strategy trades the tickers XIV and VXX. Now, the XIV itself doesn't have option trading available. So anytime we're talking about trading options on volatility products, we're usually talking about a ticker called the SVXY. Performance and trading volume is nearly identical on both of these products. The only differences are tax treatment is a little bit different, and of course the SVXY has options available. So let's get into this. Before we get into the reasons why it's not a good idea to sell these types of options on volatility products specifically, first we have to actually go through what it means to sell a put or a covered call. So the best way to explain things is always just to go through an example. So even if you don't have any option trading experience at all, hopefully this will get the point across. So let's open up the Thinkorswim platform and get into an example. Now, I execute all my trades through interactive brokers, but I always use this software for my examples because it looks the nicest. It's very clean, nice layout, vibrant colors, so this is my go-to software for videos. So let's first do an example of what's called an out-of-the-money put option, and we'll use a company that everyone is familiar with, Apple. You can see it's currently trading at a price of $145, and let's say we don't want to actually buy it for $145. Maybe we think that it's a little pricey, and we'd be more comfortable getting in at around $135. So we can check the option string. That's this here. And we'll sell this August contract that expires in 37 days. So the 135 strike is currently trading at about 102. So we'll sell that one for the put, and that's what it looks like. You can see it a little better as a picture. So here's the same trade again. Now you don't have to hold the contract until expiry. But keeping this as simple as I can, we're going to assume that we do hold everything to expiry, just for this example. So 37 days from now, there's essentially two things that can happen. The first is, Apple is trading above 135. So if it's anywhere in this range up here, above the 135 strike that we sold, the contract expires worthless and we'll keep the 102 premium that we sold. And that 102 equates to about 0.7% gain, so not too bad. We can make 0.7% on our money without ever actually holding the stock, as long as it stays above 135 by the August expiry. So if you were to do this every month, you could actually generate a pretty good monthly income. Now the second thing that could happen is 37 days from now, Apple is trading below 135 down here. If that's the case, since we sold the 135 strike price, which is right here, if it expires below this, we'll get what's called assigned. Essentially, we're forced to buy it at this 135 strike price. It wouldn't matter if it was down at 120 or even over here at 100. We'd still have to buy it at 135. That's the contract we opened. Now, you can cash settle the difference and not actually take delivery of the shares, but effectively it's the same thing. We're buying in at 135. So if that were to happen, if it expires down here, we still keep the 102 premium that we sold. That's ours no matter what happens. But if it expires down there, we'll own Apple stock at 135, which we were ready to do anyway. So that's an out-of-the-money put. Some people sell them with the goal of just collecting that premium without ever actually holding the stock, and others are doing it to make a little money until they do get assigned, so that they can buy the stock at a discount. Either way, the important thing is it's usually based on a comprehensive fundamental analysis of the company, and the trader determining that the strike price you sell is a good price to buy it at. If you're willing to buy Apple at $135, then why not sell the put? Maybe you just get a $2 premium, but worst case scenario, you own it at a price you were willing to pay anyway. So on individual stocks and indexes, anything that you can do fundamental analysis on, selling out of the money puts can be a solid strategy. Now let's go over a covered call, and again, we're going to use Apple. This time we're going to assume that we actually already hold the stock at about $145. And maybe the same fundamental analysis that told us that $135 is a good buy price, we've also decided that if it goes higher than, say, $155, it'd be overvalued at that point, and we'd be willing to sell our holding at $155. So we can sell what's called a $155 covered call. It's covered because we own the underlying stock. So here's that August expiry again, 37 days from now, and we're going to collect 95 cents for this contract. So same deal, at expiry, two things can happen to this trade. The first is if Apple stays below 155, so anywhere to the left of this hash line. In that case, we just keep the 95-cent premium for the covered call that we sold, and nothing happens. We still own the stock at 145, and we made a little bit of profit. If Apple expires above 155, so anywhere over here, then we get our stock called away at 155. And again, same thing, if it's all the way up here at 180, or even all the way to 200, we still have to sell it at 155. That's the contract that we entered. And again, like I mentioned, you don't have to hold them to expiry. You can actually just cash settle them, and then you can keep your shares. But effectively, it's the same thing. You'd be cashing out at 155. We still get the 95-cent premium no matter what happens. And since we owned it originally at 145 and now we're selling it for 155, essentially we make another $10 profit. So again, you can see the appeal here. If a person does a fair value price analysis and determines that 155 is overvalued, then selling a 155 covered call has no downside. Most likely, you'll just make 95 cents in premium and nothing happens. You just keep your shares. But worst case scenario, you sell it for $10 higher than today's price and you make money anyway. Now sure, you wouldn't make as much as if you held on and it happened to go all the way up here, but you still make money. You're getting paid for what you were willing to do anyway. So these are two very popular and very simple option strategies that can be used to generate profit. If you don't own a stock and you're willing to buy it at a cheaper price, then there's no real downside to selling an out-of-the-money put option. If you do own the stock and you're willing to let it go if the price rises, then again, there's no real reason not to try to generate some extra profit by selling a covered call. I actually have a full strategy I've been trading for many years now that's based on this. Basically selling out-of-the-money put options to generate premium, and then when I get assigned, selling covered calls to generate more premium, and eventually get rid of the holding. It's a basic wheel trade, and it's actually very successful on stocks and indexes. Now back to the original question. Are these good strategies to be using on volatility products specifically? The simple answer is no. In my opinion, there's never a situation where this would make any sense. In the last, say, 1 to 2 years, investing in volatility products has exploded in popularity. It's the new fad. But despite how many people now have, skin in the volatility game, so to speak, it doesn't change the fact that these are very complicated products, and most people still don't understand them. Most people still think these are just regular ETFs that behave like stocks, but they're not. The reason we don't sell options on volatility products specifically is because price has nothing to do with them. And I know that sounds strange to a lot of you that have experience trading stocks. When discussing valuation of Apple, for example, price is the most important thing. Apple at $200 or Apple at $75 would dramatically change the trade recommendation. But on volatility products, that's just not the case. Fundamental analysis, price-to-earnings ratios, discounted cash flow models, dividend discounting, moving averages, MACD, RSI, I could go on. But none of these things have anything to do with volatility products. Remember, supply and demand does not drive their price. It's purely driven by a known method of rolling a composition of VIX futures. Take the XIV, for example. There may be times in the future where a price of $100 might be a screaming buy. Volatility metrics might be extremely favorable at that time, and buying it at $100 might make perfect sense. There may also be times when a price of $25 is a terrible time to buy. The VIX futures term structure might be backwards by then. The VIX to VXV ratio might be inverted, and all the volatility metrics that we measure might be telling us that $25 is a terrible time to get into it. At $100, great buy. At $25, wouldn't touch it. I know that sounds strange to some people, but that's the point. These are strange products. They don't behave anything like stocks or indexes. So we need a completely different mindset when investing in them. Anytime you see somebody willing to set a specific price at a future date, unfortunately, it means they don't really understand that price means nothing. And there's no possible way to determine what we're willing to buy and sell at in the future. We have to wait for that day to come. Analyze all the volatility metrics in that specific moment, and then decide what we want to do. I can say right now with confidence that if Apple dropped from 145 to 75, I'd buy it. As long as the earnings are maintained, a big drawdown would just be a buying opportunity. But I can't even tell you what I'll do with volatility products 2 days from now, let alone significantly in the future. The SVXY is at 158 right now. If we sell a put option 1 month from now at, say, 140, thinking that if it drops in price about 10%, that would be a good buy, when that date finally comes, maybe the VIX term structure is strongly in backwardation. And maybe all the volatility metrics on that day are telling us that we wouldn't want to buy it at 140, or maybe even take the opposite side of the trade and look to be shorting it at that price. Or if we did own it right now and we sold a 1 month covered call, thinking that if it goes up in price by 10%, we'd be willing to get rid of it at that price. When that day comes, maybe all the volatility metrics are strongly in our favor and are telling us to keep holding it. Again, we're going to have to wait for that day to come to know how to react to it. So in conclusion, and considering the sheer number of people that are dipping a toe in the volatility investing pool these days, it's extremely important to understand that even though you can buy and sell them like stocks, they don't behave like stocks. They don't derive their price like stocks. And therefore, we cannot trade them like stocks. I see the same thing sometimes with people talking about how you buy volatility products after a drawdown, or use dollar cost averaging, or maybe martingaling and scaling into positions. In certain situations, those can all be effective ways to trade stocks or indexes. But with volatility products, again, price is meaningless. If the XIV suffers a drawdown from 80 to 60, that is in no way a buy signal. That might be a terrible time to initiate a trade. So I can't use my put and call option strategy on volatility products because it does require a fair value determination at a future date. But there's no such thing as fair value on vol products. Saying that I'm willing to buy the XIV at 60 because that's a good price compared to 80 is about as relevant as me saying I'm willing to buy it at 60 because fire trucks are red. Now, I'm joking. Obviously, the color of fire trucks has nothing to do with this, but that's my point. The price of the product itself is equally meaningless. It still comes down to a specific volatility analysis in the moment, and there's no way for us to determine what we're willing to do at future dates. It's best to just consider volatility products on an island by themselves, and technical analysis and traditional investing methods are not going to be of any use to us. So I'm definitely anticipating some follow-up questions to this video. I understand that it's a pretty strange concept, so send in your questions, ask me anything you want. Thanks for watching. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all 3 of my trading strategies for a full 2 weeks absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you. So go ahead and leave those in the comments section. See you next time.